absolutely shocking collapse and the incredibly high-stakes turnaround of the financial tech giant, Fiserv. Over $32 billion in shareholder value. Just gone. Wiped out in a single day.
Look, this isn't just a story about a bad quarter. This is about how a company that's literally part of the backbone of global commerce just fell apart. We're going to get into how it happened, why it happened, and most importantly, what comes next.
So, to really wrap our heads around how a company like this could just plummet, you first have to appreciate the sheer scale we're talking about. I mean, Fiserv is no small-time player. We're talking about a systemically critical piece of the global economy. This is the tech, the plumbing, for thousands of banks and literally millions of businesses. You know, when you swipe your credit card or check your bank balance on an app? Yeah, there's a really good chance Fiserv is the one making that happen behind the scenes. And the whole company's strategy was built on these two powerhouse pillars. On one side, you've got the super high-growth merchant business. Think platforms like Clover going head-to-head with Square. Then, on the other side, you have the unbelievably stable, profitable financial solutions business that provides the core technology for banks. So one was the gas pedal pushing for growth, and the other was the rock-solid foundation. And then came the day it all just completely came crashing down. On this day, Fiserv dropped its third quarter earnings report. And what happened next? Well, the market's reaction was nothing short of historic and unbelievably brutal. The stock absolutely cratered. It dropped as much as 44%. I mean, that was its worst single-day performance in the company's entire history. Billions of dollars just vanished in a matter of hours. Yeah, looking at this slide, you can see exactly why Wall Street just freaked out. This wasn't just a tiny miss. This was a catastrophic failure to live up to expectations. Missing revenue by over 8% and earnings by almost 23%? For a company this big, that is a 5-alarm fire. No question. And, you know, if the earnings miss was the fire, this right here was the gasoline poured on top. The company didn't just lower its guidance, it completely obliterated its own full-year forecast. Slashing growth from 10% all the way down to around 3.5%, that just shattered their credibility. It screamed to investors that management had no idea what was actually going on in their own business. So, the billion-dollar question, right? How does a company this big, with all this data at its fingertips, get it so catastrophically wrong? Well, the answer isn't so simple. In this moment of, frankly, rare and brutal honesty, the new CEO, Mike Lyons, basically came out and said, yeah, we did this to ourselves. He pointed right at a culture that was obsessed with hitting short-term numbers instead of making smart, long-term investments. So, you see, the collapse wasn't just one thing. It was this toxic cocktail of 4 really deep-seated problems. You had a culture of short-term thinking, a dangerous reliance on unstable growth, nagging problems from a huge merger, and, to top it all off, serious allegations about its star growth product, Clover. And this chart, wow, this just perfectly shows the dependency problem. A massive chunk of that 16% growth they were bragging about, it wasn't coming from everywhere. It was overwhelmingly from a single hyperinflationary economy in Argentina. They call that a mirage because it's not real growth from more business. It's just growth from soaring prices. And once that bubble popped, the weakness in the rest of the business was exposed for everyone to see. Okay, so the company is in a full-blown crisis. What do you do? Well, Fiserv went for a complete overhaul of its leadership and strategy. This is their big bet, their gambit on a comeback. Management rolled out this One Fiserv plan. Now, I know this can look like a bunch of corporate buzzwords, but each one of these points is a direct response to one of those root causes we just talked about. It's a 5-point, back-to-basics reset. They're trying to fix the fundamentals they ignored for so long while chasing the short-term wins. And to pull this off, they brought in a whole new best-in-class leadership team. And they weren't just playing musical chairs. They went out and poached their direct competitor's CFO to fix their forecasting mess. They hired a renowned expert from Stripe and GM to fix their core banking business. And they brought in financial heavyweights to oversee the whole thing from the board. So all of this, the collapse, the diagnosis, the new plan, it leaves investors at this critical crossroads, asking themselves one really important question. And this is really why this story is so fascinating from an investment angle. You have 2 completely opposite takes on the company's future. The bulls, they see a wounded giant that's on sale, a great company at a bargain price.
They're betting the new team and the strong core business will fuel a recovery. But the bears? They see a company with deep cultural rot, and they're warning that competitors are going to eat Fiserv's lunch while it's busy trying to fix itself.
You can see analysts have pretty much mapped out these futures. And man, the range of possible outcomes is just massive. If the turnaround fails, the stock could basically just stay where it is. But if this new team pulls it off perfectly, the upside could be huge. The whole investment case has shifted. It's not about their market position anymore. It's a straight-up bet on these new people.
And this right here, this is the key risk for anyone looking to invest. It's the chance that the stock isn't a bargain at all, but a value trap. It looks cheap, sure, but it's cheap for a very good reason. The real question is whether these problems are temporary and fixable, or if they're permanent and structural.
So at the end of the day, is Fiserv a deep value opportunity, or is it a classic value trap? The answer really depends entirely on whether this new team can execute one of the toughest turnarounds we've seen in modern fintech. The core assets are still there, but the damage was incredibly severe. The road to redemption is going to be a long one, and for investors, the question still stands. Is this a giant on the verge of an epic comeback, or is it a ship that's still taking on water?